This is the Kestrel Country Podcast, where we discuss the people, places, and events all around Kestrel Country. Welcome to another episode of the Kestrel Country Podcast. I'm your host, Mike Church, joined this week by Brandon Allen. Thanks for coming in.
Thanks for having me, Mike.
With Synergy One.
Synergy One Lending.
Is this your third time on the podcast?
I think it is.
I think it's your third.
You get better and better.
Frequent flyer miles, man. Yeah. Well, thanks for coming in. Appreciate it. And coming down. This as we head into September coming up almost.
It's going by too quick.
Crazy.
Got kids back in school this week.
I know. Kids are back in school. All of a sudden, archery season is like right around the corner. So I don't know how much hunting I'm going to get in this year, but there is a giant buck out there running around that I got my eyes on. So
that photo, what a toad!
I know.
What a toad.
We shall see.
Yeah, you're going to get ace on him?
I don't think so. Well, we'll see. I mean, if I don't, it sounds like a terrible dad thing to do. I'm going to get first crack at him.
There you go.
But that's just because I'm an archery hunt. Ace is going to rifle hunt. So if I don't get him in the archery season, then yeah, we'll try to get Ace on him during the rifle season.
Good for you.
Yeah. Well, we're here to talk primarily about mortgages, homes, rates, recession, all the good news, right? Everybody's just super cheery right now in the news. All the red this morning.
Yeah, goodness gracious. We're seeing big drops in S&P, all equity markets down. I mean, we're losing gains big time. S&P's down 2.13%. NASDAQ's down 2.5%. And really all this is in response to Jerome Powell coming out this morning.
Yeah. Right. So, give us a little bit of background there. And then I know we've already covered this in a past podcast, but explain why the Fed rate is not the same as mortgage rates. Yeah. Because people hear the headlines. I mean, I used to think that. They were like, Fed's just raised rates. And it's like, oh, okay, they raised mortgage rates. Like, no, definitely not the same thing. So, first of all, what happened? Yeah. They're hanging out in Wyoming, Jackson Hole. Yep.
Yeah, so Jerome Powell basically came out. He's speaking at a symposium today where the markets were really anticipating some comments coming from him about what the Fed's position is going to be on continuing to raise the Fed funds overnight rate, which is essentially the rate that banks lend overnight to each other. This does have a lot of indications in regards to what the Fed is trying to do, who controls economic and monetary policy, right? Yeah. What the Fed is trying to do with the economy. We know we've been fighting record high inflation, and there's two ways to really reduce inflation. One is through taxation, and the other is through raising rates. So they're wanting to intentionally slow down the economy by making borrowers less apt to go to banks to borrow money, because if banks lend each other money overnight at a more expensive rate, they just pass that down into their consumer lending products like credit cards, equity lines, auto loan rates. So they're trying to slow down the economy through that mechanism. Why it doesn't impact mortgage rates all the time in the same way is because simply that interest rate doesn't control the bond market. The value of the debt that's created is going to indicate what the rates are going to be for the money that you're borrowing. So.
And is that because the mortgage rates, mortgages are they're controlled by this secondary market?
That's right.
Right? That people are buying these mortgage-backed securities. We learned all about that after 2008.
Yeah.
So whereas the products, those retail products you're talking about, those are just directly a bank right to the consumer. They're controlling those rates. Whereas this is more controlled by, hey, what is the market going to do with these mortgage-backed securities?
Exactly right.
Okay.
So investors are going to have an appetite or less thereof for purchasing bonds, which is somebody's promise to repay the debt, and they're going to get a margin off of that. So if mortgage bonds or the mortgage debt is seen as a valuable asset that's more safe, it's more of a safe haven than stocks, right? Ownership parts of companies, then the price of that bond is going to increase, which is simply indicating to the market that we want more mortgage debt created so we can put them into bonds and investors will have a higher rate of return. But when investors sell off that debt, then bond prices go down and mortgage rates go up. It's just a gas pedal. And I think we talked about this on the last podcast a little bit, but the unique part of what's going on right now is that mortgage bonds are following the stock market. When the stock market's up, mortgage bond rates are up, and they normally have an inverse relationship to each other. Investors are either more apt to go into stocks or bonds, not normally the same thing. And what we've seen for the last few weeks is that they're actually kind of following each other. When the stock market's up, mortgage bonds are up, and vice versa. So when
the bond rates are going down,
yep.
That's when mortgage interest rates are going up.
That's right.
Obviously to entice investors to buy those mortgages, right?
That's right.
So when you're saying that they're following stock market today, I pulled up the Wall Street Journal when I got to the office. It was like, oh man, that's painful, right? Everything's red, everything's going down. Yeah. Are we seeing the same thing then? Are mortgage rates up today then?
They are. Yeah, mortgage rates are up today. We're starting to see some midday positive movement. The 10-year Treasury, of course, is another great indicator of where mortgage rates are going. But the Treasury is up today, down from where we started this week. So mortgage rates were up really high on Monday and Tuesday. They got a little bit better Wednesday and Thursday. Today we're looking pretty flat. So investors are kind of holding tight. It's really weird because there is going to be a time when the bond market and stock market disconnect. And this is one of the really big head scratchers that's going on right now. It's almost like putting two magnets together with the same poles. They just don't want to go together, and that's inflation and recession news. So it's just really an interesting time. What we're seeing, and I think most prevalently, the thing that we're going to see in the next couple of weeks is that there will be this disconnect between the two. Recession fears are going to take over. Mortgage rates are going to start dropping back down. Fingers crossed.
Okay, so that's the hope.
That's
right. Well, nobody hopes for a recession,
right?
But as far as mortgage rates, for those people who are out there, you were mentioning earlier, like all those clients whose rates are floating right now.
Yeah,
that's the hope, is that they'll start to diverge a little bit, and we'll see that drop.
That's exactly right. And the administration right now is being very intentional in trying to curb Americans' fears of a recession. We had preliminary GDP come out yesterday, another third quarter negative GDP. From a technical level, 2 quarters of GDP is a recessive economy. Very interesting redefining of a recession came out last month, but ultimately the technical benchmarks are we're in a recession, which normally means great things for mortgage bonds. Right now we're seeing that like tug of war take place.
Yeah, so talk about that a little bit. Why are you saying that? What we went over this. You came by our team meeting earlier this week. What makes you say that the recession, us being in a recession, is going to be a good thing for mortgages?
So if we take a look at this graph from fed.stlouisfed.org, which is a great economic site, thousands of graphs that you can see, particularly around real estate. In conjunction to, since the 1960s, but what it's doing with recessions. We see every time that we go into a recession that interest rates drop. Obviously, when we're looking back, 1975 through 1985, some massive movements. But then the more modern day recessions that we see, 90, of course, we see the early 2000, and then the big one, right, 06, 07, 08.
Yeah, so the 06, 07, 08 one, that's what everybody's got in their minds, right?
Yeah.
That's the most recent, that's fresh in everybody's minds, and it was terrible, right? So what it seems like everybody right now is like, man, I don't know, backing off the real estate market a little bit. Mm-hmm. What's going to happen? We're heading into recession. And in that last recession, it was really a housing caused recession, right? So we saw a drop in housing prices, and then coming out of the recession is where we started to see some rebound.
That's right.
Right? But you're saying that the fact that we're going into this recession without that big drop in prices might mean that lower interest rates, which is it universal? Do they always are interest rates always, mortgage interest rates always lower during a recession? Well, I guess always is a big question, but we're looking at this back to
early 1960s.
What? Okay.
And we can see in every time there's been a recession, we see interest rates drop. Now, that doesn't mean that when interest rates go down, we're in a recession, because obviously peaks and valleys here. But essentially what happens is in a recession, the economy slows down. Consumers stop spending their money. They hold on to it. And in order to get out of the recession, the Fed lowers their Fed funds overnight rate, which is enticing people to go out and borrow money. Naturally, that means that the housing sector is a part of that, and investors pour their money into mortgage bonds as a safe haven from the drop in equity markets, right, like stocks. And naturally, that means that interest rates go down. Bond prices go up, interest rates go down, people start spending their money more, and of course, housing being one of the main drivers of our domestic economy, it just touches so many different industries. But I think one thing to acknowledge is the fact that the last few years have felt a lot like 2004, 5, and 6, from the sense of it seemed like everybody had money, boats, toys, side-by-sides, big trucks, gas-guzzling vehicles when gas prices were down. It really felt like those years.
Yeah, that's a good point.
And so now when we start to hear about recession coming back right on the heels of all of that money pouring into the economy, I can see why consumers feel that way. But the data is, yes, we do have a decline in demand for mortgages. We do have a decline in demand for housing, but we're not seeing a collapse of the housing market. If we go back,
that's for sure.
Right. If we go back to this graph, this is the median sales price sold for United States. Again, same time frames. We can really start to see that the decline in home prices, the value of homes, started well before the recession was indicated. And that's really what led us into the recession, was this crash in the housing economy that came from bad mortgages.
Yeah.
Bad mortgages led us into this.
Yeah. And so what has happened in the last, so I liked what you said about, hey, it feels a lot like 04, 5, 6,
yeah.
right? What is different right now in the mortgage world than it was? Pretty much everything. I mean, it seemed like everybody and their brother was borrowing money the last couple of years. What changed? What should make us feel okay about that?
Yeah, the standards for the mortgages that can go into mortgage bonds, which ultimately drive interest rates, the standards of those mortgages have dramatically increased. Consumers know within 3 days of their application what their estimated closing costs can be. There's a certain margin of change that can take place from the initial estimate to the final closing cost. So consumers are well more educated, number one. Number two is what's called the ability to repay. That's probably the biggest change, is debt to income ratios are managed so fiercely in the mortgage world that a consumer has to prove through documentation and historical data in their income that they can make that payment going forward for 3 years at a minimum.
Okay, so let me be the devil's advocate here.
All right,
the hard questions. But what happens if a bunch of people start losing their jobs?
Yeah, well, that'll happen.
Right? Because the ability to repay is all well and good if you still have that job that you had when you applied. But what if a bunch of people start losing their jobs?
Well, there will be an increase in the foreclosure rate. We know that every recession there's been an increase in the foreclosure rate. The levels that we had in 2006, 7, and 8 were dramatically higher. I don't have the data in front of me to talk about foreclosure rates, but if people do start losing their jobs, there will be home sales.
Yeah.
The problem was, in those times, is that you had homeowners with 3 or 4 mortgages at one time. So it just multiplied when somebody wasn't able to make their ends meet. The homes were getting listed and they weren't selling. So you saw short sales happening, right? Where you sell the house for less than you owe on it. There's this differential between that.
Yep.
So there will be an increase in foreclosures. Is it going to be something that's a foreclosure crisis like we had in 2006? Definitely not. Yeah. It would take a massive, massive economic issue for that to take place. Yeah.
Well, one of the things that has been going through my mind as well is that we've seen so much of a gain in equity over the last few years. I mean, somebody was just telling me Boise, it's like, almost doubled in the last couple of years?
Dang near.
Was that you? Just telling
me that? 28 or 36% a year over year. Both
incredible. Years. And so, they might, values might decline there for sure. They, what goes up must come down to a degree, but there's so much cushion in there that people are going to still have a lot of equity left in their homes. Which is a good thing. The other thing that I've been thinking about is I know that you were saying that the Fed, one of the things they're trying to do is really loosen up the labor market.
Yeah.
But at the same time, there is such a labor shortage all over the place that it seems like it's going to be pretty hard for people not to have some other avenue for getting another job or just backfilling. And then you combine that with the fact that we're still millions of housing units behind when it comes to just population growth and building over the last few years. I think that's what I've come back to is, the housing crash. Who knows? It's a crystal ball. We don't know exactly what's going to happen here, right? Like we could really hit into a giant recession that affects everything, right? But at the end of the day, Econ 101, right? You go back to high school and it's like supply versus demand.
Yeah, that's right.
At the end of the day, there is still strong demand for housing just from a population standpoint. I mean, there's just, we need housing. And the supply is still really low. And one of the things I've found interesting to kind of watch is you're seeing a lot of builders pull back, which is not necessarily a good sign for the housing market, but we're getting ahead of things versus the last recession, right? The last recession, everybody was caught by surprise, and there were half-built subdivisions everywhere. Like that was a huge part of it. You go into these bigger markets. Well, I'm hearing from friends in Boise, there's, a lot of contractors are canceling their reservations on lots. They're not building. They're not putting in those basements. So it's kind of like we're prepared for it in a way. So maybe the fact that everybody's a little gun shy is going to keep us out of that type of situation because, home builders just aren't massively overbuilding.
That's actually another really good point. I think it's pretty safe to say that if we had the supercharged economy continuing for another year or 2 years, where a lot of these new phase home starts took off, that we could have found ourselves in a bad spot. But when you're talking about home appreciation, going back to this graph, we see this skyrocket starting in 2020 when rates dipped. Demand just exponentially grew at a rate that was not sustainable. If that would have continued, we very well could have seen ourselves in another bubble. But it does seem like it's being caught pretty early on. Now, do we think that we should have printed all that money for the 2 years that we did? No, we're seeing the effects of inflation from that. Right, still a bad move.
We might not think that, but they're looks like they're going to be printing a lot more of it.
It's not slowing down, it seems.
Yeah, I didn't have any student debt, but now I do apparently. So just taking on other people's.
That's man, we could go down a rabbit hole there. Either way, I think that there's no spending our way out of inflation, right? We've got to slow down how we're spending money. But when it comes down to consumers, we're seeing gas prices fall a little bit. That's a good thing. It feels like it's at least moving in the right direction. Are we there yet? No. And that's essentially what Jerome Powell said, right? Hey, we're going to keep doing this until the job's done. But the problem is that it's almost we're going to create the problem and then fix it and beat our chest like we did this great thing. It's like, no, we're just correcting the error of our ways. And the way we have to do that is going to be painful in some ways, right? There is the loosening of the labor market. That means an increase in unemployment. And we just need to call it what it is. And I think one of the things, and you tell me if I'm wrong here, Mike, but one of the things that I feel like consumers in the marketplace are hesitant about is these trigger words, right? We've seen a shift in the market. We're seeing a softening here and there. We're balancing out. Let's just call it what it is, right? Home prices, there's more inventory on the market right now than what there was last year, right?
Active inventory, yeah.
Active inventory.
Yep.
Okay. Homes are not flying off the shelves like they were the last 2 years.
Yeah, exactly.
We're not getting $50,000 over ask minimum, it felt like, for a little while there. But were any of those things really good?
No, absolutely not. Yeah, I think on the last episode with Catherine was talking about that. It's like we're seeing a normalization is really what I'm seeing so far. We'll see what happens going into fall, but it feels like the market has normalized from that last 2 years, which to your point about that graph, this seeing in 2020 just this huge spike, that was abnormal, that was crazy, that was out of the norm, and it was, people were doing things that weren't smart. I'd never suggest anybody get a home without a home inspection, and buyers would insist on it. Or our buyers would lose out to buyers who wouldn't get a home inspection, or all these different things that they were doing that just weren't healthy. It wasn't helpful. And now I think things are just normalizing a little bit more, where you do see that week to 2 weeks on the market. some longer, but things are just feeling a little bit more normal. Buyers are able to take a breath. They're able to actually go back and look. It's like, I felt terrible if somebody would be like, well, can we think about it for a couple of days? Like, no, it'll be gone, right? Like, can I think about where I'm going to raise my kids for the next 10 years? Like, no, sorry, you got to decide right now. Like, it's terrible.
Yeah.
But now, somebody can go back. We can go look at the home again. You can consider it. You can weigh it against other options. People can just start feeling like they're making better decisions. And then what I'm hoping for is that we'll see a bit of a normalization to the seasonality as well. So in the last number of years before the last two, in Moscow, things would really slow down in the summer. July, August were a little slow. It was a bit of like a summer lull, summer slump. Once kids went back to school, you get into September, October. September and October were often a couple of my busiest months. And so we'll see. But I'm hopeful that this normalization is going to go in that same direction, and we'll see a little bit more activity. And obviously, if interest rates do start to come back down, like you're talking about going into fall, we really could see a nice bump moving into fall.
That actually aligns with some of the macro data that Fannie Mae came out with in June, which said the levels of mortgage debt that's created this year and into 2023 is looking like it will be on par with 2018, right?
Interesting.
Before things got a little hectic. So we are moving into a normalization. And I think that, like you said, nobody has a crystal ball, but hopefully we see that continue.
Yeah.
When it comes to what rates are doing, though, right now, I think we'll maybe pivot over to this snapshot of the Fannie Mae 30-year 4.5% coupon. Yeah. We're seeing this resistance level. We saw this resistance level formed in June. We saw it again in July. But this is one of the things that I think will really help consumers see that the Fed raising interest rates does not equate to what's going on in the mortgage world really well. So right in mid-May going into June, we heard rumblings that the Fed was going to raise rates 75 basis points, right? A big hike. And bond market responded really poorly. Investors started dumping their bonds and rates shot up. We saw the highest point in rates.
Yeah, so that's that dip you're seeing is the bond market dropping, rates doing the inverse.
Exactly right. Yep. This long streak of red. And right after that, Fed raised the rates, and we had this really nice 3-week period of rates getting better. They basically went back to down where they were in mid-May. Of course, they went up just a little bit again. And then in July, Fed comes out and raises rates another 75 basis points, but no drop-off, meaning no skyrocket in interest rates. In fact, rates got better.
Is that, correct me if I'm wrong, but it seems to me that's analogous to what the stock market does with, like, for example, the war in Ukraine, right?
Yeah.
War in Ukraine. Is Putin going to invade? Beginning of this year, it was like, is the weather going to do it? And is he going to do it? And the market was just dropping. He invades Ukraine, and it starts going up.
Yep.
Right. It's because it's already built in.
Exactly.
Right. So is that the same idea here? The market kind of built in the fact that they knew the rates were going to get raised, so they were dropping, and then once they actually happened, it's like, yeah, okay,
it happened.
It happened.
Yeah.
We're moving on.
It's all based upon speculation when it's pre-interest rate, Fed funds rate increase.
And is that so now? Like today or yesterday? Was it today that Powell came out and said that? Today. He says they're going to continue to raise rates. Everyone expected that, I'm assuming?
I think so.
And so is that partly why you're thinking that we might have a similar trajectory here of rates going back down?
I think so. And ultimately, one of the biggest reasons why is because when the Fed says we're going to raise interest rates, the Fed funds overnight rate, until the job is done, what he's really saying is until there's a recession. They don't want to come out and just say, we want to drive our economy into a recession.
Yeah.
We want this soft landing. All of that is just fluff. It's trying to not cause this really hard knee-jerk reaction in the markets. But recession equals better things for interest rates. We just saw that on the graph. So yes, I do think this is baked in. When the Fed raises rates in September, I think we're going to see another rebound. Now again, no crystal ball here. I don't have a degree in economics, but after 10 years in finance, I think that's what we're going to see. It has to happen. There needs to be that disconnect between stocks and bonds.
What are you seeing with locally, your basically whether that's applications, pre-approvals, are you seeing strong demand for it? Are you seeing people pull back a little bit? What's kind of, obviously all the housing market, everything is inherently local.
Yeah.
And so, what are you seeing from a lending side locally?
From a lending side, we're going to be about 10% up this year as far as the volume of mortgages that were created. We did see a slowdown in referrals, pre-approvals this month.
Okay.
Same thing that we saw in July, around the 4th of July, which we hear is very consistent with Moscow's market, right? The Palouse region. Same thing right before you go back to school, a little slowdown. Looking back at our data from 2018, 2019, before the craze happened and there was no slowdown, same thing.
Yeah.
So I think we're going to continue to see a strong housing market here. We're not overbuilt. We don't have a ton of new inventory coming. We have the opportunity for new inventory to hit the market, but that's still a year out, right? So same thing. I think we're seeing a seasonal dip, and it's going to charge back, until the holidays.
Very good. And what are you telling people? Are you telling people to float right now, if they can?
This week, yes.
Yeah.
If you're closing in the next 2 weeks, basically you're getting what you're getting. If you didn't lock previously, this is where you're going to be at. It's going to sting for a little bit. Watch the market for the refi, and we'll get things moving then. But if you have the opportunity to float, I think right now is a decent time to do it.
Okay.
So let's talk a little bit about why this is all, I think, even relevant, which is one of the main reasons why real estate's purchased so consistently in America is because it's part of a wealth generation, right? The creation of wealth. There's no ability, the vast majority of us don't have the ability to outpace our earnings in wealth creation that real estate can give us. If your 401k increases by 5%, you have 40 grand in there. And then your house is worth 400,000 and it increases in value by 5%. Which one of those is going to yield more wealth in a shorter amount of time? And of course, it's going to be your home's appreciation.
Yeah.
Because it's appreciating based upon the value of the asset. So this is a graph that I learned from a coaching company that I subscribe to. It teaches me about business, team creation, mortgages, and faith. It's been fantastic for me, but this model is not mine, so I don't want to infringe on the creator of it. Yeah. But it's basically been reviewed by some of the top financial managers in the nation. And this model has outpaced, when they did analysis of it, outpaced what they could offer in their own professional services. So you're looking at primary luxury real estate. And that term luxury is simply a home that you're proud to live in. It's not well below your abilities as far as payments concerned, because again, that asset will appreciate based upon its value, not the money that you put into it, and then looking for rental income, investment property, second home, commercial.
So this is basically looking at how does real estate fit in with your overall wealth creation strategy?
Exactly
right. That's the idea. Yeah, which is interesting because one of the things that I learned from my dad and have told people too is like, you don't necessarily want to think of your home as an investment, but it probably is a big investment. I don't know. It's an interesting thing because on one hand, it's a place to live. It's where you're going to be. It's not. I think one of the things that got us in trouble in the past is everybody thinking like, oh man, this is going to be the best investment ever. I need 4 different houses, right? Yeah. And that's maybe the difference is because you're saying primary luxury real estate, meaning, living in a nice home, having a home that maybe it is your place to live, to enjoy. It's not like your primary investment category. It's your house, but that's a way to continue to build wealth over time. That's exactly if we were to go back to that graph from 1963, right? You see a significant appreciation over a long period of time.
Exactly right. And there's no real 10-year window where you buy a piece of property and the value hasn't increased since the 60s.
Yeah. It's probably more thinking about it in terms of like that's a piece of the wealth creation puzzle, but it should be seen still as your primary home.
That's right.
Not just an investment, right? Because
100%.
I think one of the things that I've been telling people too is like the last couple of years, you could buy a house, do basically nothing to it, sell it the next year and make great money, right?
That's right.
Same thing with like buying Tesla stock or whatever. It was like everything was going up. You could just buy it and sell it and do well. We're probably moving into the type of market where you might have to hold a home for 3 or 4 or 5 years before it really ends up appreciating enough to deal with, moving costs, closing costs, realtor fees, all that stuff. And so if you're thinking about it more as that long term, I don't know. Does that make sense to you?
100%. Yeah, I think that's a well-rounded perspective on it. Our buying a home is inherently logical, but it's exceptionally emotional.
Yeah, right? 100%. That's great.
And we got to balance those two out. The next piece of this is once you buy that primary luxury home is to get your reserves back, your liquid reserves back to $25,000. And I think there's 2 reasons for this. Number one, it's going to keep you out of consumer debt, high interest consumer debt, credit cards, lines of credit. But it's also going to give you the ability to weather a financial storm. There's very few problems in life that you can't solve with $24,000 or $25,000. And if there is a bigger problem than that, you have a pretty big problem, right? So get your reserves back in alignment, $25,000. Once you hit that, then you start to take these next steps. What do you see from clients that are coming in, the vast majority of clients? Do you feel like they're adequately positioned in their savings if they share that with you?
They don't as much get into that with me. So yeah, I mean, that's maybe it is something I shouldn't outsource as much, but it's like that's more something that they're talking to with their lender, with their financial advisors. I think that I would say probably most people aren't adequately positioned in that way. I do try to prepare people for the costs of home ownership. And I think that's partly why this is so important, that $25,000 in reserves, is that especially if somebody's been used to renting, right? Yeah. They're not necessarily going to be, prepared when that furnace goes out, or prepared when, hey, that when we're looking at this house, that roof has got a few years left on it. It's not necessarily a big red flag on your inspection, but just know you better start budgeting to replace that roof. Like there are those problems that can be fixed with $25,000. For a lot of people, a fair number of those problems might be house problems.
Sure.
Right? Something happens, something, goes out. They need to replace a bunch of, or maybe not need, but want to replace a bunch of flooring or those kind of things. $25,000 doesn't go nearly as far on a remodel as it used to, So I do think that's something that people need to be thinking about and planning for a little bit more.
Rate of savings, yeah. I would say the vast majority of clients that come in to buy their first house will deplete the savings that they have down to a couple months of reserves. And the idea here is to look at what's your rate of savings going to be after post-closing, after you're making that mortgage payment. Do you have enough to adequately build your savings back up?
Yeah.
Again, this is just an ideal picture, right? Again, the majority of clients are wage earners. So they have a job, they have a 401k. It brings us to this next quadrant here, which is to max out your 401k and your IRA, especially if you have an employee match. Savings, get your $25,000 and then your 20% savings per month goes right into these investments until you max it out. Also diversifying with a few mutual funds. And then the Mac Daddy of all of this, which is tanking today, but historically is the most consistent producing index fund, right, in our nation's history, which is the S&P 500. 500 of the largest companies in America, very consistent, averages 9.3% rate of return per year over the last 30 years. Put your money in it. I think that when we think about how we manage our money, and I'm guilty of this, is being hesitant to put my money into the stock market. It took me a long time to start putting my money outside of just a savings account. I wanted to see it. If I wanted to run to the bank and withdraw it, I wanted to do that, but that was strictly emotional. And when we think about actually creating generational wealth, it doesn't happen on accident, right? The families that are actually passing down to their children's children, they didn't do that on accident. They had a plan and they followed it, and they kept emotions out of it. What are your thoughts on it?
Yeah, it's funny. There's always like anytime you have a wheel, these kind of things, there's balance. Yeah. It's about balance, right? And being a real estate guy, like that's what I love. Like I'm definitely off balance. Like that's where I tend to go is into real estate. So I have a bias towards it. I like maybe some of that's even like control. Like I like being able to see it, touch it, feel it, work on it, manage it myself versus like, man, who knows what all these companies are doing. So that's kind of my tendency, but that it all makes sense. Yeah.
At the end of the day, as long as you're investing, right? As long as you have a plan and you're actually investing, then over time, and we're not talking about short-term day trading where you're trying to ride it up and sell off before it falls. We're talking long-term savings. Nobody should put money in CDs right now. Biggest joke is the rate of return in your savings, right? Get your money into a position. But the other thing is there's a danger, especially we've seen this in the last 2 years, is there's this danger that everybody needs to be an entrepreneur of some sort. Everybody needs to buy an investment property. And I think one of the things that we have here locally is this kind of a false expectation that you need to be buying rental properties over and over again. And I'm not trying to knock investing into real estate by any means, but make sure that you're doing it wisely. Like if you're going to buy an investment property and you have no money left over at the end of the day, is that a wise investment?
Yeah, well, that comes back to the preparing, right? Like
absolutely.
Yeah, we own some rentals and know that those surprise expenses can come up, 100%. And you better be prepared for them. And also just knowing that just buying a property doesn't mean it is a good investment, right?
Amen.
Right, it goes back to the primary thing we were talking about earlier. It's like just because you have a primary home and you're paying that mortgage every month doesn't mean that's a good investment necessarily,
exactly
right? Same with investment properties. And the reality is over the last couple of years, I've been watching, and there are very, very few good investments, in my opinion, in a lot of the rental market here. It's just the prices got too high.
Yep.
Rental rates are still low. Now I think they'll catch up, but yeah, no, I think you're absolutely right. You need to analyze it. You need to not just jump on that bandwagon. And I'm sure it's the same with the other types of financial, other pieces of the financial picture too, right? It's like everybody was doing the meme stock thing or whatever. Yeah. And it's like just because that's what everybody's doing. In fact, maybe because everybody's doing it, you shouldn't do it. I don't know. But
well, you are definitely the guy that leans on. If everybody's going one direction, you're going to pull back.
It's true.
Your tendency. True. But here's another question for you. How prevalent was the conversation of protecting money against inflation over the last year? Yeah,
huge.
Okay.
Huge, right?
How much?
Some of us use that as an excuse to buy whatever. Catherine, I need this. I'm pretty sure I used it to buy a dirt bike, which is real bad. It was like, hey, our money, we're losing money on inflation. I better buy this dirt bike. It didn't work out so great for me, but
hey, you know what? We've all got to do it. But how much of that do you feel like came from an emotional response to the talking points, right?
Yep.
Rather than a strategy to employ long term.
Right. Yep. I agree.
I would say a lot.
Yeah, that's interesting. I hadn't really thought about that much, but that could be why we saw such a runaway and consumer spending and that kind of thing. Is people were just like spend, and they had the money. The money was cheap and easy, and so hey, let's get it into the economy, which was obviously part of their goal.
Sure.
Right? Coming out of COVID and all that stuff was like, hey, we need to inject money into the economy.
100%.
We need to stimulate it. They overdid it. Right?
I agree.
So now that's why we are where we are.
Because if your investment, whatever that investment is, to hedge against inflation, is not cash flowing to you, what is going to happen when you need that money? You have to sell the investment. And you might have to sell the investment when it's lost value. So I think that this is why looking at a well-rounded, and this diversified portfolio, right, that we all hear about but don't know really what it is, is why it's so important to actually have a strategy.
And talk to a financial advisor,
Absolutely.
Right? Because neither of us are one. Are we supposed to say that? Is that like a thing you have to do?
We are not financial
This
advisors.
is not financial advice.
Legal disclaimer.
That's right.
But it's dangerous. And find one that's a fiduciary, right? Find one that has a legal obligation to do what's best for you and not try to sell a product that's going to make them more commission. Because if you're not, everybody's persuaded by money to some extent, which is another great talking point, right? No lender out there, no matter who you work with, their compensation cannot be based upon your interest rate, your fees, your program, or your term. It's strictly based upon the amount of debt that you take out. And that's
interesting.
A federal regulation.
I don't think I knew that.
Which is important for consumers to know. And I think that going back to how things have changed since 2006 and 7, right? That's one of the biggest ones. Consumers were being sold into products that made the lenders more money, that were less advantageous, if not predatory towards the consumer. Fascinating stuff.
Yeah. No, that's really, really interesting. So are you seeing buyers or borrowers becoming much more rate conscious now? Or do you think it's really was it the same when interest rates were super low? Did people care less whether your rate was lower than somebody else's than they do now?
Well, I think as an industry, we shot ourselves in the foot. What did we sell on for the last 2 years? Interest rates.
Yeah.
And what are we not wanting to sell on right now because rates are higher? Interest rates. So yes, of course, we've conditioned consumers. We are conditioned as consumers to be very rate conscious. And everybody wants to know what the rate is. I think it's something that's super important to understand the cost of the money that you're borrowing, but also to understand what's the strategy behind it. If rates are over, I had a client last month that simply did not want to buy. They were 100% ready to buy. Reserves, down payment, closing cost money set aside, stable jobs, great FICO scores, very little consumer debt. I don't want to buy a house because the rate's over 5%. Man, there was just no logic that you could employ to help them feel differently. And it was an emotional decision because what are we still seeing in home values? The estimated home appreciation is up year over year. We're expecting another 13% appreciation on the top end, down to 7% on the bottom end in the next 12 months. So is your interest rate at 4% and the money that you'd spend at 4% versus 5% worth losing out on 7% appreciation conservatively?
Yeah. Well, I think that's where it comes back to, we're talking about the emotional decision and maybe it's not right for those people to buy right now, right? I mean, it depends on there's a lot of circumstances, but is when they're so focused on that loss of appreciation or whatever that they're losing focus on, hey, this is a home, right? Like this is true. This is a place to live. This is a place that you can have pride of ownership in, that you can work on, that you can do things, that you can raise your kids in, that, like there's a lot more to it. And maybe that's partly why I really like real estate is it is this like tangible pride of ownership, this thing that you can see and walk by, rather than just being in the stock market or whatever. And I think that's where the conversation I think is going to go a lot more. It's more like, okay, what are your goals? Financial goals are important, but there's a lot of other goals that are more important, right? And what well, maybe the housing market's going to drop. Yeah, maybe your landlord's going to raise their rent by $200 a month when your lease is up, right? Like that's a very real thing that's going to happen because I do think there's a lot of places under rented in this town. And with the increases in taxes and fees and everything else, and just cost of money and all of that hitting landlords, it's going to have to hit tenants as well. And that's another thing to keep in mind is you're fixing that rate over the longer period of time versus you could end up, especially in this town. I mean, there's basically zero vacancy, so you could end up either having a massive increase in your rent or not even having a place to live
and be stuck. Right. Yeah. Because if people aren't buying homes, let's say Armageddon does happen, where do they live? They rent.
Yep.
Which means that demand for rentals go up. And all of that money that you are pouring into the safety and security of having a dwelling is in the hands of somebody else. It's definitely a balance. Are you finding that people are becoming more hesitant on engaging with you in open and honest conversations around home ownership?
No, I wouldn't say that. I think overall volume is just down.
Yeah.
So fewer people overall talking, I know like some of our agents are dealing maybe more with younger first-time home buyers, and they're seeing more of that hesitancy like you just talked about of like, you know what, I'm just going to sit on the sidelines for a little while. Catherine and I were joking yesterday. I was like, maybe we should just tell people like, you should really just sit on the sidelines for the next 2 months during hunting season. And then, I think the market's going to pick back up. So I would just recommend not even looking at houses for the next couple months.
That's funny.
That's obviously a joke. But, I do think some people are like in that hesitancy mindset, which is understandable. Things have been very volatile this summer, and it'll be interesting to see what happens going into fall, how things settle out. And like I said, I'm expecting to see activity pick back up as we get into fall, as people want to get things done before the end of the year, before the snow flies. That happens a lot. So, but we'll see what happens. It's Moscow is it's a great place to live, great place to own property, and so I think it's going to continue to be that over the long haul.
So outside of hunting season, what would be the best way for somebody to contact you if they were one? Of course, joke again, but what would be the best way for somebody to get raw information without feeling like, of course, you're not pressuring people to buy, but what's the best way for people to get information about the housing market and their options when it comes to your services?
Yeah, I mean, obviously, I think, and there was somebody just quoted, I can't remember where that article was, but it was kind of dogging on Zestimates.
Oh, yeah.
Did you post that?
I did.
Yeah, dogging on Zestimates, and it was like, what's the best way to find out? It was like, talk to a real estate agent. Yeah. But it's true. I mean, having somebody, just like your T-shirt there, lend local, right? It's like having a local lender, having somebody to advocate for you and to help you out, having that personal relationship, I think is super important. Some friends just started, this is a total tangent, but you'll see how it relates, a handyman company called My Guy.
Oh, there you go. And
I thought it was great because everybody wants a guy in whatever space. It was this Sicilian guy that was a customer of my dad's back in Detroit. That's what he told me when I first got into real estate. He goes, Mike, like everybody wants to have a guy. What you're talking about. He's like, hey, you need something, call my guy.
Yeah,
you call my guy. He's got it. And but I think that's true. Like you want your mechanic. Everybody wants to have their person. And the same is true in this, if not more so. Like you just said, finding that fiduciary financial advisor. So for sure, talking to them. I mean, we do try in our social media as well to put out a lot of data, put out a lot of information. So that you can get that raw data. But yeah, I think that's obviously the place to be. And I think, again, the housing market slowing down hopefully will allow buyers to become much more educated. And I tell people all the time, it's like, just go look at a bunch of houses. Like that's what we're here for, is to help you out. And don't feel bad about like, let's go look at that one. Maybe it's not exactly what we want, but let's go walk through it. You walk through 5 or 10 houses, you're going to feel so much more confident when it comes time to jump on it, right? And I would assume the same or similar for you. It's like I tell buyers, like, go meet. Maybe you think you're a year or two out from buying a house. Go meet with Brandon. Go meet with a lender. Talk to him now about it and start thinking through it, running those numbers. Yeah. So you're not like, oh man, there's the house I want to buy, and now I'm behind the 8 ball. And right. I'm rushing to get it all figured out. Right. I think that's some of the good things about this market slowing down is just figure it out. Take a breath. And sure, if you want to take the next 2 months off and go hunting, I'll be fine with that. No, but it's just slow down, gather the information so that you can feel confident. Like that's what we want, right? Absolutely. We want to be able to help them feel confident about those decisions. So
that's really good. Well, I'll tell you, Mike, and I say this honestly, this is not just because I'm on the Kestrel Country podcast, but I've told many people that if something happened to me, if I went into a coma and my wife and daughters needed to buy a house, I would trust you and your advice that you gave them, truthfully and honestly. So if you have questions about real estate, hit up Mike Church. He's going to give it to you straight.
I hope that doesn't happen.
Yeah, me too.
Of course.
Me too. Yeah, you're just an honest, straight-up guy, now. And you have the respect of a lot of agents in town, many agents outside of your brokerage, and I respect you a lot. So thank you for having me on today. And when it comes down to buying a house, it's never too early to start understanding the information that's going to allow you to make a confident and educated choice.
100%. Yep. Start early.
Good deal, brother.
That's it.
Thanks for having me.
Yeah. Thanks, Brandon.